What is going on, everybody? Welcome to the live stream. I appreciate people jumping on today. And we're testing out a little bit on audio here and just making sure that you can hear us well and that sort of thing. So if you can, just pop into the chat here. Let me know that it's coming through loud and clear. And as you make comments and all that sort of stuff, I love to see the names come through so that I can see who is joining me. But we got definitely some good stuff to talk about today. I know there's some things in the news that people want to know about, and just to be able to do these live streams on a monthly basis is a lot of fun. And from the feedback that I'm getting a lot of hearing that you guys are getting a lot of value out of this. So Ray, Kelly, thank you guys for joining. Dawn, thanks for being here. And Allie, thank you for letting me know that it's coming through loud and clear. I also do want to just encourage you guys to post questions into the thread here. Any questions that you have related to taxes, I'm on for the next little while to answer those questions and make sure that you have a good understanding of the things that you're concerned about. I also do have some questions that people have emailed me, and so I'm going to go through some of those questions. So I do have a base of kind of what I am going to start out with, but I really do want to give a lot of encouragement to have people jump in and ask questions. Also, if I go through something and you need some clarification, feel free to just drop that into the thread here as well. So anyhow, I'm going to get into it. We just had some pretty big legislation passed, and it's called the Inflation Reduction Act. You've probably seen that over the past couple weeks go through Congress, and some of the feedback that people are getting depending on what side of the aisle you're on. There's good and bad, pros and cons, but it is signed into law now, and it's one of the things that is a reality now. We are dealing with it. And so somebody asked about the 15% minimum tax that's going to be levied on corporations. I kind of, in my practice anyways, want to maybe calm some nerves on this. This is related to C corporation income, and that minimum tax is only going to apply for people who have over $1 billion in revenue. And I would love if there's people who are joining me on this type of thing that have C corporations with over $1 billion, but the clients that I'm typically focused on and have been working with are definitely under that threshold. But so it's not really necessarily something that we have a lot of concern about in small business. And the reality is a lot of the Inflation Reduction Act, and I still have a little bit more to read on it, but a lot of the Inflation Reduction Act really doesn't have a huge impact on what is happening in small business right now, other than possibly the $80 billion that they've given the IRS. Now, that is concerning, but it's also, on another hand, could be really good. The IRS, especially in the past couple of years, we've figured out that they are very much understaffed. They don't have enough people to answer phones. They don't have enough people to resolve issues that business owners are having. And so hopefully, and you know, we're waiting to see on this, but out of the $80+ billion, you know, I did see that $4 billion of it was earmarked for technology improvements, which I think is, you know, you needed to probably triple or quadruple that number to catch them up from a technology standpoint. But hopefully from a staffing perspective, there's going to be more people who can kind of hop on and help out with some of those types of issues that we're having. So that being said, it remains to be seen, but I don't really think that $80 billion would be being invested in the IRS if there wasn't some plans to expand their return on that. And so I do think what we will see is a big uptick in audits. I also do think that there is going to be a lot of time that's going to be needed to get revenue agents up to speed. I mean, you can't just go hire, thousands of people off the street and expect them to go through and start auditing people's tax returns. They don't, have the skill sets there. So there is going to be some of that kind of stuff that just remains to be seen. But what I really want to emphasize with this is making sure that you're really dotting your I's and crossing your T's in how you run your business internally. And that is such a huge piece of what happens in IRS audit, IRS examination. They want to make sure that you are operating the way that you should be. And if you are, that does calm the nerves for sure. So, I'm emphasizing bookkeeping, making sure that you're keeping your books, keeping receipts, making sure that you're keeping a mileage log, making sure that you're doing reimbursements for things that you pay for personally, and just going through your tax return and making sure that it's accurate and that we've done the things that we should be doing. So that's a huge thing when it comes to what's happening with the IRS audits, the $80 billion. I know it's a big talking point to be able to say, hey, they're coming after you and all that sort of stuff. And to some degree, I would take that. I would say, yeah, maybe they are coming after you, but we have the opportunity to prepare ourselves and make sure that our ducks are in a row. And so those will be some of the things that I'll focus on a lot in Prosperity Society and have so far. If you viewed some of our videos, you'll see that I'm really focused on how to be compliant, how to make sure that you're doing things the right way. And so those are a couple things from the tax front that I think are big within this bill. Now, there's other stuff that's in there. There's expanded health insurance benefits. It's an expansion of the Affordable Care Act. And so there's money that's being put into making sure that people who had subsidies for health insurance, that they continue to receive those subsidies. So you have some of that kind of stuff. There's a capping of prescription drug costs that need to be looked at. And so few benefits like that are out there as well. One of the other things that you maybe have read about or noticed is that there's a big investment in clean energy, and there's energy credits that are being extended, expanded, and that sort of thing. And so those are things that you can take advantage of if you are buying an electric car, for example. There's a credit that goes along with that. There are some things when you make improvements on your home, along the lines of replacing maybe your HVAC system or your pump system with solar type stuff. There are residential energy credits that are out there. So those are things that I would probably do in separate videos, but I wanted to just make sure that you were aware of those things. If you're in tech businesses and you're developing technology, research and development credits can be really, really awesome for somebody that's developing a process. And internally we would use kind of a specialty firm that would look at those types of things to make sure the certain types of expenses that you have with developing that are expenses that qualify for the credit. So increased research and development credits is something that's really, really big when it comes to, if you're in a tech type of space. So Inflation Reduction Act, we'll see. I mean, I think it's called the Inflation Reduction Act, but I don't really know, if it's going to calm inflation. I mean, anytime the government says we're going to spend $787 billion or whatever the number finalized at, you've got to think to some degree that that still could cause inflation. So, the title, it may not be all that it's set out to be, but there are some bullet points within it that we can be looking at, and you'll probably see impact your tax situation. All right, somebody says, I haven't done my 2021 tax return yet. Am I in trouble? No, you're not in trouble. 2021 tax returns, personal tax returns, are due October 15th. So outside of this video, if you called me up, I am either going to be working on people's 21 tax returns, or maybe spending some time with my kids over the next 2 months. So that's something that you don't need to be too stressed about right now, but you should be starting to get your stuff together. What is the Aircon credit? I have not heard of the Aircon credit, so that'll be something that I'd need to look at a little bit closer. I haven't seen that, so that's something I could take a peek at. But let me get into a little bit of real estate stuff. I do have somebody that asks a specific real estate type question, and it's kind of an interesting one. I think this is one that maybe people have experienced or will experience at some point, and so let me jump into it. The question is, the client has a personal residence currently that they've been living in for years. And what they want to do is buy a second property in another state, but they're not really necessarily ready to move there yet. And so he kind of wanted me to go through some of the different scenarios. So scenario number one is a wait and see approach. And your pros and cons with going along with that really just depend on what happens in the real estate market. I mean, if the real estate market ends up jumping up, then you're going to be sitting there, wishing you would have bought the property. But if the real estate market crashes in the next couple years, you might have actually saved yourself from overpaying. And so there's the wait and see approach, which basically is a coin flip. I mean, none of us can really predict that future, but if you end up waiting, you keep yourself less leveraged as far as maybe a potential debt that you may have to take, but you also don't have that second home that you can go to in California and visit and spend time with family. So there is the wait and see approach on that. It does save you from paying interest on debt. So there could be some cash savings on that, but really it's a coin flip. Let's say that you're like, you know what, I don't want to wait. I actually do want to buy it, but what do I do with that property? So scenario number one would be, I'm going to buy this property and I'm just going to rent it. So you find a renter, have them sign a lease, and you do that for the next 2 to 3 years, and until you're ready to move in, and you have an income stream. So maybe somebody's paying the majority of the mortgage, or maybe they're paying all of the mortgage for you, and so you build equity in that, and in the meantime you have a rental. So your tax return has a rental on it, but after interest, taxes, depreciation, it probably wipes out at least most of the interest or the rental income that you would have. And so it's really kind of from tax perspective, it's probably going to wash out because it's a rental property, but you have somebody that is there at the property, hopefully taking care of it and keeping it up to date and that sort of thing. But you have a chance to rent it for a few years. And then, like I said, the market can go up or down, but you're going to live in it for the rest of your life anyways. So who really cares? I mean, you don't care. You don't necessarily care in the short term whether it goes up or down because it's already been purchased. So you can make it a rental. The next idea would be to make it a short-term rental. I mean, depending on the location and where it's at, in my experience, people who do short-term rentals, they have a huge opportunity to do much better than what you can get from a long-term renter. So, you may be able to rent something out for $300 or $3,500 a month, but if you have a short-term situation and it's a bigger house and can sleep a lot of people and that sort of thing, you can charge $500-$600 a night and find yourself in a situation where it's like, well, if I just rent it for a week, that would be the same thing as having a long-term renter. If I rent it for 2 or 3 weeks, now I'm suddenly making 10 grand a month off of it or whatever. So I kind of like the idea of a short-term rental just because it has a lot of upside and maybe not as much wear and tear as somebody that signs a 1 or 2 year lease. So you get a lot of upside on the cash flow on that. How it affects the tax return is you would be in a situation where now you have a business essentially. I mean, short-term rentals are more like a regular business, but at the same time, you still have interest, taxes, depreciation, and all that sort of stuff. And so you find yourself in a spot where you have some deductions to offset that income. And even on top of that, there's some tax strategies that you can implement possibly in the first year where you get a big tax deduction through something called a cost segregation. Cost segregation is a way to accelerate depreciation on your property, and that potentially is a big offset against your active income because we treat the short-term rental stuff like it's a business. And so that actually can offset your active income. I could do a whole 30-minute video on that strategy itself, but it is a good strategy that I'd love for people to have in the back of their minds or to just ask more about. Now, so we got wait and see, don't buy it. You got do a long-term rent, a short-term rent. Let's just say, those are the 3 options that you could kind of look at. Option number 4 is kind of like, okay, fast forward into the future here, and you're ready to move into it. The question becomes now, well, what do I do with the old property? Well, the old property you've lived in for a long time. So when you've lived in a property for 2 of the last 5 years, there's an exclusion, a capital gain exclusion in Section 121. Section 121 says if you lived there 2 of the last 5 years, then you would be able to sell that property, and if you're married filing joint, you can exclude $500,000 worth of capital gains. So that's huge. So let's say you bought a house for $500,000, you end up selling that property for $1 million, you would pay no taxes on that transaction if you're married. So you find yourself in this spot where, okay, do I sell it? Do I hold it as a rental? And really it just depends where you're at. I mean, if you were going to hold it as a rental, you can hold it as a rental for 3 years and then do the sale, because then you would live there 2 of the last 5 years. So if you want the rent income, by all means, rent it out for 3 years and then decide, do I want to sell it? If it's too much of a hassle for you, you just want to end up on a beach somewhere and you don't want to have to be worrying about a property in a different state, then you sell it, pay your capital gains, and move on with life. But it really just depends kind of where you're at with things and what you want to do as far as your family goes. But if you wanted to hold it forever, you totally could. And when you pass away, your kids would inherit that property, and as the tax law is written right now, they would get a stepped up basis to whatever the fair market value is when you passed away. So, I would kind of say you have a 3-year window to decide. You're either going to rent it for a couple years and then sell it, but I would not wait 5 years and then decide to sell it, because then you lose your exclusion. So hopefully that kind of helps out just a little bit when it comes to that kind of stuff. All right, let's see. Somebody asked me, what is an opportunity zone? is it a good thing to invest in an opportunity zone? In the 2017 tax cuts that President Trump signed, there was a big piece of money that went into investing in opportunity zones. And what they did all along the map in the United States is they identified areas that were maybe a little bit run down. They needed investment. They wanted investment money to come in and improve certain areas. So, what ended up happening is all these different areas were identified. And what it happened is it gave investors a chance to be benefited by investing in those areas. Because a lot of times when you have money to invest in, your first thought is not, let me go to the crappiest neighborhood. Sometimes it is, don't get me wrong, but it's not the first idea, is to go to the worst neighborhood and invest there. But what this ended up doing was giving people a chance to make that investment, some initiative, some incentive. So what they ended up saying is they said, okay, if you sold a property, if you sold stock, you had a capital gain. Then you need to, what you want to do is you want to make sure that you end up taking that capital gain money and moving it to one of these opportunity zones. So the opportunity zone is, this certain area, and what they said is if you end up investing in that area, then you don't have to pay taxes on the capital gain. And so it ended up being really kind of cool, where it was one of those things where it's like, okay, let's just say I had $100,000 capital gain because I nailed the stock market, and I ended up doing a great job with that. Well, that 100,000 is it normally would be taxed like $20,000. But if I ended up saying, oh, you know what, I'm gonna end up going to an opportunity zone. If I took that $100,000 and invested in real estate there, or a commercial building, single family residence, apartment complex, any of that type of stuff, and I held my money there for 10 years, then I would get an exclusion from the capital gain. So the opportunity zone ended up becoming kind of a really cool thing for people that had these big capital gains from projects that they were doing, and they were able to move those into areas that really ended up needing more development. So, I really like the idea of the opportunity zone. Billions of dollars kind of went into this, and people who are against it would say, well, that just made areas less affordable because there was now nice properties and different things like that. So it just kind of depends on how you look at it. But overall, the program ended up bringing billions of dollars into maybe the neighborhoods that maybe needed it the most. So that's the opportunity zone. And if somebody asks me, is it a good idea to invest in an opportunity zone? I mean, I think if you have a big capital gain from something and you have a chance to not pay taxes on it, there's a trade-off. You have to give the money up and invest in something else, but that can be a really, really good tax planning tool. So that's kind of my opinion on the opportunity zone. All right, another way that people don't pay taxes, and we're talking about real estate here, so I might as well kind of just stay on track with this. But somebody asked me, should I invest in a Delaware statutory trust? And a Delaware statutory trust is something that is used in conjunction with a 1031 exchange. A 1031 exchange is when you sell a property, you've got a capital gain, and then you take that money that you received from that capital gain, roll it into a like-kind property, and it's a way that you can defer your taxes. So it's basically like if you've heard, well, if I sell my property and roll it into something else, don't I not have to pay taxes on it? You've probably heard it said that way in simple terms. Yeah, that's what it is. A Delaware statutory trust was kind of created just as like a maybe a little bit more of an advanced way of doing a 1031 exchange. It was meant for people who maybe wanted to potentially invest in bigger projects like apartment complexes and big commercial properties, different things like that, and maybe they didn't have all the money to get into. So, what ends up happening is a lot of people kind of end up getting into a Delaware statutory trust. It kind of operates similar to a real estate investment trust and can still receive a exclusion of their capital gains, but they're doing it because they have a tenant in common. They have other investors that are all along with it. So this is something that's pretty rare. I will say that I don't really see it a ton in my practice. I've maybe dealt with it one or two times, over the past few years. And it's one of those things that can be really good. You get monthly income. They have internal people who operate it all, and if they're normally on the up and up, you're getting monthly income from, say, a college apartment or something along those lines. I've seen people who would, maybe they sold a big piece of land or something like that, and then kind of maybe were older and just wanted set income coming in every month, tend to like roll it into something bigger like that where they get guaranteed monthly income. You don't need a lot of money to get into it, and that's a way that people are like, I'm invested in an apartment complex or a big office building or something like that without having to have $40 million. So that could be good. Question come through says, do you like Delaware or Wyoming better for businesses in general? That's more of a legal question. A lot of C corporations set up in Delaware. And then, Wyoming is a state where they have anonymity laws. So if you own an LLC and you have Wyoming as where you created that LLC, they're not going to just advertise who owns that LLC. So a lot of people like Wyoming because they give that anonymity. And, I know that there's places that are set up that put asset protection packages together and really kind of have, some protection and shielding when it comes to Wyoming for laws. So I see a lot more Wyoming. I don't know if that's because we're on the West Coast, but I see a lot more Wyoming than Delaware. I know both states are very business friendly. I know for the most part, business licenses are cheap and that sort of thing. But anytime somebody's kind of figuring where should I structure and that sort of thing, I think that's important to have a consultation on and just make sure that you really need it, number one. Number two, that, it's not just something like, oh, I heard I have to do it this way. Because there is a lot of misinformation out there. But most of the businesses that I deal with are just set up in whatever state they live in. And even if you did set up a business in Wyoming, for example, let's say like I'm a CPA and I live in Utah. Even my business is actually set up in Nevada. Like I'm a Nevada LLC, PLLC. But even though I now live and work in Utah, I still have to register my business in Utah. If I wanted to, maybe set up in Wyoming to get some anonymity, I totally could. But the name of my business is my name. So I'm not really going to get a lot of anonymity on that sort of thing. So it really just depends on your situation. If you live in California, and let's say you're operating a business out of California, California has a minimum $800 LLC tax. And so a lot of times what people try to do is they say, well, I'm just going to go set up in Nevada or Wyoming and avoid the California LLC tax. That's not always going to work. And so, if you're hearing that it really does come down to where you live. And most of the time in your business, wherever you're operating, you're going to have to register your business in the state that you're operating in, even if you are set up in a different state. Now, a lot of times what somebody will do is they'll do something like, well, okay, fine, I'll set up in California and I'll have ABC LLC that's selling widgets online or whatever. But then what they'll do is they'll set up another Wyoming LLC and have the Wyoming LLC own the California LLC. And that's a way that you kind of shield who knows who the owner is in the business. So, that's something that is an asset protection type strategy that I know that I've seen people implement. All right. Another question that I ended up getting is along the lines of these residential energy credits, maybe even some home builder credits, commercial building credits. There's a section called 45L in the code. Code section 45L, be upfront, is not something that I deal with a ton, but it is a specialized type credit that is out there for people who are developing properties that are energy efficient. So 45L is going to be, and there's going to be specialty firms that specialize in calculating out your 45L credit. So if you're out there and you're developing let's say you're building a commercial building, you're building an office building. If you put solar roof panels on and, inside you have energy efficient lighting and you have a energy efficient HVAC system and all that sort of stuff, 45L is going to come into play on something like that. So, there is money that is being contributed into energy efficient type stuff. And so it's important to know that if you are working on a project like that, you definitely want to hire one of these specialty firms to come out and help you calculate the credit. But internally for me, that's not necessarily a credit that I'm seeing a ton, or that's not necessarily a calculation that probably most CPAs are going to be really focused on. And CPAs are most likely going to say, we want you to consult with a specialty firm that deals specifically with the 45L calculations. And I do the same thing with cost segregations. I do the same thing with conservation easement stuff. I'm doing the same thing with research and development credits, which I've talked about. And so those are the types of things that there are firms out there that are specifically set up to know all the ins and outs of that sort of stuff. Let's see. Another thing that I ended up getting that I think is worth mentioning is real estate is typically what's called a passive activity. So if you have rental properties and you make over $150,000, you're going to end up having something called passive loss carryovers. All right? And those losses that are going to accumulate are only deductible if you have passive income. So you have to have rental income to offset the passive losses if you want those losses to release. So let me give you an example. Let's say you have a rental property, you rent it for 10 years, and you make over $150,000 a year. After interest, taxes, depreciation, all the HOAs, all the different stuff that we pay for with rental properties, let's just say each year you had a $2,000 loss. And so over 10 years, you have this $20,000 loss that's just sitting there on Form 8582 as a passive loss carryover. Now, the only way that you would really be able to use that $20,000 is if, let's say, one year your rental income went up a lot and you had $2,000 worth of income instead of a $2,000 loss. Now that bucket of $20,000 would wipe out the $2,000 and you'd be at zero. So you have to have passive income to use passive losses. Now, what ends up happening sometimes is, let's say you have multiple rental properties. Let's say you had 3 rental properties and that same thing happened for all of them. What ends up happening is you would be able to use some of those passive losses to offset rental income from any of the other properties. So if you had a lot of passive losses on one, you could utilize those if you had passive income on others. Nothing wrong with that. Another way that you can actually use that bucket of 20,000 is if you sell the property. If you end up selling the property and you have capital gains from the sale of that rental property, the whole bucket of passive losses will release. So let's say you sold it and you made $100,000. You would have a $100,000 capital gain on one line, and then you'd have a $20,000 passive loss released on the next line. A lot of people will say, can all the passive losses offset the capital gains? The answer to that's no, not necessarily. All the passive losses and capital gains are 2 separate buckets. So you're only going to, you had a $100,000 capital gain, but that doesn't necessarily equate to now I can take all the passive losses from all of the properties that have been out there, because capital gains and passive losses are reported in 2 different sections. So if you sold one of the 3 properties, that bucket from the property that you sold, that one bucket of 20,000, that's what would be released for you on the tax return. All right, a lot of those questions came from Ray Akazawa, and he's in the thread here, which I appreciate him, and giving us a lot of cool content to kind of run through. And I think Prosperity Society members and people who come to this live stream will realize that the community is what is going to make it really great. And having people who log on to these things and listen to them and ask questions, because the same things that a lot of you guys are asking about, there's going to be other people who are dealing with the same type of stuff. So anyways, I'm continuing to build this community. I'm continuing to do more videos on a weekly basis related to Prosperity Society. You've probably seen a bunch of my emails that are going out to help you guys out. But I really want to encourage people to log into our video database and start looking at those. It's one thing to do the videos and put them out there, but I need people to go down that rabbit hole every once in a while and just say, you know what, I'm going to soak in a bunch of Ronnie's videos and make sure that I'm on the up and up and I'm doing things the right way. Maybe just to seed this a little bit, in the coming months, after I get through extension season, really September and the first half of October are really big when it comes to me doing taxes. Like, I'll file a couple hundred returns in the next 2 months. But after that, I'm totally going to be focused on tax planning. Tax planning is such a huge part of my relationships with people. And so what we're going to end up doing is we're going to have section that's all set up for tax planning. It's going to have all the different things that we need to be focused on and looking at. And so I'm kind of seeding that a little bit. I want you to get excited for it, because this platform right here that we are building out, this database that we're building out, is something that we're totally committed to. And even though there's a fee associated to it, I have no doubt that the fee associated with it will be minimal compared to the knowledge and information that is out there. So I'm looking forward to continuing to build this. And I hope that you guys will join me in it and give me suggestions, give me different things that you want to see as part of the platform, because I'm always looking for videos that I know will help people. So feel free to get through that type of stuff, and I would love to continue to just build this out. But I know it takes a little bit of time, but the community will definitely grow. And my hope is that it's a community that helps each other. So, anyways, that's probably it for me today. I do appreciate everybody coming in and joining me today, and I hope everybody has a great day. Thanks so much.